Let's go ahead and go through the translation of a foreign subsidiary's trial balance. Now, again, the translation is sometimes referred to as the current rate method, and under that method, all assets and liabilities are converted to dollars at the current exchange rate. Assets and liabilities, we're going to use the current or end-of-year exchange rate. The paid-in capital accounts, common stock and paid-in capital in excess of par, are going to be converted at the historical rate that existed at the date that we acquired the subsidiary. Retained earnings is a little confusing at first blush. In the year of acquisition, it'll be converted at the date of acquisition exchange rate. In subsequent years, we will carry forward the dollar value of ending retained earnings to become the beginning of year dollar value retained earnings in the following year. Revenues and expenses, now we would like to convert these at the rate which existed on the date the revenues or expenses were recognized. Instead, we'll generally convert them at the average rate over the course of the year as a reasonable approximation of that day-to-day exchange rate. So let's go ahead and do this example. Let's assume that our 80% owned subsidiary has the following trial balance at the end of 2015, our first year of ownership. Let's go ahead and assume that we bought the subsidiary on January 1st, 15 when the exchange rate was $1.40 per euro. We paid exactly book value for them, so there was no differential. And again, this is basically a euro-denominated trial balance. And let's assume we have the following exchange rates. Again, January 1st, 15, $1.40 per euro. At the end of 2015, $1.10 per euro. The 2015 average, $1.20 per euro. And on April 1st, 15, when dividends were declared, an exchange rate of $1.30. So again, we're going to simply apply the appropriate exchange rate to the various financial statement elements. So again, all of our assets, contra assets, and liabilities are going to be converted at the end-of-year exchange rate of $1.10 per euro. Our common stock and retained earnings will be converted at the date of acquisition exchange rate of $1.40. And again, next year, we're going to take the end of this year dollar value retained earnings. Again, we're going to have the beginning of year dollar value retained earnings plus dollar value income minus dollar value dividends equals end of year dollar value retained earnings. That will be carried forward as beginning dollar value retained earnings the following year. Our revenues and expenses will convert at the average rate of $1.20. And finally, the dividends will convert at the April 1st rate of $1.30. Now, we go ahead and add all these things up. So again, we simply multiply the euro values by the appropriate exchange rate to get the dollar totals. Now, the dollar trial balance is not going to balance except by amazing coincidence. Again, the euro-denominated trial balance balanced, but since we applied different exchange rates to different financial statement elements, the resulting dollar-denominated trial balance will probably not balance. So we add up all of the debits, the assets, the expenses, and the dividends, and we have $829,000 in debits. We add up all the credits, the accumulated depreciation, the liabilities, the equity, and the sales revenue, get $878,000. And so again, our trial balance is out of balance. To make this thing balance, we need a $49,000 debit. That will be our translation loss. So we're going to add, again, this is essentially a plug figure, to make the subsidiary's dollar-denominated trial balance, we add a $49,000 debit, which will be the translation loss. And again, this is part of other comprehensive income. So let's go ahead and set up our dollar-denominated income statement. Again, we've taken all of that euro-denominated information and converted it to dollars. Once we have it in dollars, all of the euro information is completely useless to us. Everything now is going to be based on dollars. So we have dollar sales of $540,000, less dollar expenses, cost of goods sold, depreciation, and other expenses. And so we have dollar-denominated net income of $90,000. So let's go ahead and go through our equity method entries. And now these are going to be just as they've been previously. The only addition is going to be we have to deal with the other comprehensive income. And again, we talked about this some time ago when we first started talking about the equity method. So now this, as I promised, this is coming back to haunt us. But anyway, under our equity method entries, we own 80% of the subsidiary, so we own 80% of their $90,000 of net income. We also get 90% of the dividends that they paid out. And we also get 80% of that $49,000 translation loss. So at this point, sort of see where this is going. If you were to visualize the worksheet for the consolidation, under the parents column, Big's column, we have $39,200 of other comprehensive income dash translation loss. Little, in their column, has $49,000 of other comprehensive income dash translation loss. And so in the elimination process, what we're going to want to be left with is we want to show the entire $49,000 other comprehensive income. We will deduct out the share that accrues to the non-controlling interest, and the remainder, $39,200, will be the other comprehensive income to the controlling shareholders. So our elimination entries, and again, these are going to be just as they were previously. The only thing we have to deal with is this new other comprehensive income. Now, so basically we're going to eliminate our beginning of year common stock in dollars and the beginning of year dollar value retained earnings. And that total will be split 80-20 between the investment in Little and the non-controlling interest. Again, nothing new here. This is exactly what we've done previously. There's no A for amortization because this was done at book value. So I for investment income, we eliminate our $72,000 of reported investment income. Our NCI entry, we allocate to the non-controlling shareholders their 20% of the $90,000 of dollar valued income. And now we deal with the other comprehensive income. And as I've said repeatedly, there are any of a number of ways we could organize our elimination entries. One way, which the textbook which we utilize uses, is they go ahead and they deal with all of the other comprehensive income in one entry. So what are we going to do? We're going to go ahead and get rid of the parents' $39,200 of other comprehensive income. Basically, look at this in contrast or comparison to the I entry above. In the I entry, what we were essentially doing was reversing the equity method entry where we recognized the parents' share of the subsidiary's income. We're doing exactly the same thing here. We're reversing the equity method entry that recognized the parents' share of the other comprehensive income. Again, what we want is we want to show the entire other comprehensive income, it was $49,000, and say, okay, of the $49,000, $9,800 accrues to the non-controlling interest, leaving $39,200 to the controlling interest. So again, this is one way to organize that OCI elimination entry information. But again, keeping in mind sort of the parallels between what we're doing with the other comprehensive income and what we're doing with the regular income, let's go ahead and rearrange this a little bit. Again, what's in bold italics there is essentially analogous to the I entry. In the I entry, we eliminate the parent's share of the reported subsidiary earnings. Down here, we're eliminating the parent's share of the other comprehensive income. And likewise, what's in bold italics now here is analogous to the NCI entry. In the NCI entry, we allocate a portion of the reported earnings. In the OCI entry, we allocate a portion of the other comprehensive income. So let's go ahead and group like things together. So first, we can have sort of a two-part I entry. First, to eliminate the parent's share of the reported earnings, and then to eliminate the parent's share of the other comprehensive income, or loss in this case. Likewise, the NCI entry can be broken down into two parts. First, we're going to allocate to them their share of the reported earnings, and then we're going to go ahead and allocate to them their share of the other comprehensive income, or loss in this case. So again, the income to the non-controlling interest and the OCI to the non-controlling interest serve the exact same function in the income statement. They serve to allocate away a portion of the total income to the non-controlling shareholders. So just to save some space, let's go ahead and put this back the way the textbook presents it and the way I first presented it in these slides. And note that before making our elimination entries, again, I mentioned this a few minutes ago, both the parent and the subsidiary had the translation loss on their balance sheet. The subsidiary had the whole $49,000, while the parent would have had their share 80%, or $39,200. The consolidated financial statements should show the parent's equity account, including the parent's accumulated other comprehensive income, but as far as the consolidated income statement itself is concerned, we're going to have, again, the normal presentation is the company presents its income statement, and then immediately following that they have their consolidated income statement. And so we're going to report the entire $49,000 translation loss, deduct out the $9,800 that accrues to the non-controlling interest, leaving us with $39,200 accruing to the controlling shareholders. The remainder of the elimination entries, the A, I, D, etc., are exactly as they were in the case of the non-foreign subsidiary. Now we skipped the D entry here, so just for the sake of completeness, again, we go ahead and eliminate the subsidiary's dollar-denominated dividends declared, and we split that 80-20 between the parent's investment and the non-controlling interest. Now, when we repeat the process the following year, we will again translate all of the subsidiary's trial balance accounts at the appropriate exchange rate except for retained earnings. As I indicated earlier, the dollar value of retained earnings is carried forward from the previous year's worksheet. Now, instead of making up an entire worksheet, which at this stage of the game would just be too big to be legible, and I'd have to make it such a small font that it would be hard to see, let's just look at the statement of retained earnings section of the middle part of the worksheet, both in euros and in dollars. So again, in our three-part worksheet, the top we have the income statement, the middle we have the statement of retained earnings, the bottom we have the balance sheet. In the middle portion, in dollars, we'd have beginning retained earnings $140,000, and again, that was based on the date of acquisition exchange rate. We add the income, which in dollars was $90,000. Again, that was based on a 1.2 exchange rate. Deduct the dividends based on a 1.3 exchange rate. And so the ending retained earnings in dollars is $197,500. And so again, there's no single exchange rate that converts the euro ending retained earnings of $150,000 to the dollar ending retained earnings of $197,500. That conversion is the result of a mixture of rates, in this case over just 1 year, but as we go along, that conversion from euros to dollars for retained earnings sort of accumulates all of the effects of all of the different exchange rates which we've had over the course of history. Okay, so let's go ahead and move on to year 2, and let's assume that the subsidiary has the following euro-denominated trial balance, which of course balances. And just for the sake of space, I've gone ahead and summarized all of the assets into a single assets number, and likewise with the liabilities. And again, note that we've carried forward the dollar value of ending retained earnings from the previous year to become this year's beginning retained earnings. Now, there's one more thing we need to add. Last year, for little, they had a translation loss of $49,000. So in dollar-denominated terms, they would have had a $49,000 debit balance in accumulated other consolidated income. Now, again, this is where we start getting into a problem where our process can blind us to our goals. There are a number of ways we could approach this problem of carrying forward the translation gain or loss from the previous year. Basically, we can think ahead to what our goal is going to be. Our goal is that on the consolidated income statement, we want to have the full translation gain or loss from this year's transactions minus the amount that accrues to the non-controlling shareholders, equaling the other comprehensive income that accrues to the controlling shareholders. On the balance sheet, we want to show the parent's beginning accumulated other comprehensive income plus other comprehensive income for this year, equaling the parent's ending accumulated other comprehensive income. I've made up this presentation 3 or 4 times trying to find the best way to sort of organize this into a elimination entry sort of process. And I really think this is the best way to do it, is just, again, visualize that what we're looking for is the subsidiary's dollar-denominated trial balance, and if the dollar-denominated values, last year they had a $49,000 other comprehensive income, which would carry forward as accumulated other comprehensive income. Okay, so let's go ahead and assume the following exchange rates. Again, our January 1st, 15, the date of acquisition was $1.40 per euro. The 2016 average, and we're now in 2016, is $1.80 per euro. And the end of 2016, it's up to $2 per euro. Now, we can sort of see where we're going with this. The euro has almost doubled in value from the beginning of year to the end of the year. At the end of 2016, I believe the exchange rate was $1.10 per euro. It's now up to $2 per euro. So our investment in Little is becoming more valuable in dollars, not because Little's a better company, but simply because Little is measured in euros and euros are becoming more valuable. So we should expect to see a rather sizable translation gain this year, simply based on the increase in the value of the euro. So let's go ahead and multiply our financial statement elements by the appropriate exchange rates. Assets and liabilities at $2 per euro. Common stock or our paid-in capital accounts at the historic rate from the date of acquisition. Revenues and expenses from the average rate during the year. And again, I didn't put any dividends in just because we don't need to muddy the waters. We multiply those across to get the appropriate values. And now we find out how much of a plug figure we need this year. Adding up the total debits, including that accumulated other comprehensive income, $1,569,000. Adding up the total credits, $1,364,500, for a difference of $204,500. That's a credit difference. Basically, again, the value of Little has increased because the value of the euro has increased. The cumulative difference is about $150,000. The accumulated other comprehensive income needs to swing from a $49,000 debit balance to about a $150,000 credit balance. So this year we're going to show an other comprehensive income translation gain of $204,500. And just because we're going to need that number, let's note that Little's dollar income is $180,000. $900,000 in sales, less $720,000 in expenses. Okay, so let's go ahead and go through our equity method entries. Income, again, Little reports $180,000 of income. This is an 80% owned subsidiary, so we record 80% of that, or $144,000. There are no amortization or dividends, but again, we have our translation gain. And again, we want to report our share of this year's other comprehensive income. There was a $204,500 translation gain this year. Again, that's the other comprehensive income, not the accumulated other comprehensive income. So our share of that is $163,600. So we're going to go ahead and record other comprehensive income dash translation gain of $163,000, and that increases our investment in. Okay, finally, our elimination entries for 2016 will start as follows. As always, we eliminate the subsidiaries beginning of year owner's equity accounts. Common stock, $77,000, retained earnings, $197,500, and we also have to eliminate their accumulated other comprehensive income. their AOCI was a debit balance of $49,000, so to eliminate that, we will credit it for $49,000. So if you net the three of those things together, you come up with a $225,500 debit balance, and we're going to split that 80-20 between the investment in little and the non-controlling interest, the same as we always do. Next, we need to go ahead and do our I for investment income entries, eliminating our regular investment income, our 80% of the subsidiary's reported dollar earnings, and also eliminating our 80% of the other comprehensive income that we had recorded. And then finally, we have to allocate part of the income to the non-controlling shareholders, both part of the regular earnings, 20% of the reported $180,000 of income, as well as allocating part of the other comprehensive income. Again, we had other comprehensive income of $40,900. We're going to allocate part of that to the non-controlling interest, just as we allocate part of the regular earnings. Okay, let's go ahead and see what this looks like in our worksheet. And again, here we have the part of our worksheet that focuses on the other comprehensive income and the accumulated other comprehensive income. Again, how you organize this is largely up to you. My preference is to put the statement of other comprehensive income, the top three lines there, directly below the regular income statement, and to put the statement of accumulated other comprehensive income directly below the statement of retained earnings. So it's sort of putting like things together. In any event, the numbers on the worksheet now, those are the numbers that actually exist in Big's trial balance and in Little's dollar-denominated trial balance. Those numbers don't exist on Little's foreign currency denominated trial balance, but they do exist on the dollar denominated trial balance that we created. And then below we have the elimination entries for easy reference. First, let's go ahead and work through or work down the big and little columns. So we have the other comprehensive income of $163,600 and $204,500 for big and little respectively. That gets carried down to the bottom OCI number. And then just as we do for income and retained earnings, we transfer that down to the statement of accumulated other comprehensive income and get the ending AOCI. And again, you need to be careful with the debits and the credits here. Both big and little are starting out with relatively small debit balances, adding relatively large credit balances, so the ending balance is obviously a credit balance for both of them. We then go ahead and post the elimination entry information for those two categories, the other comprehensive income and the AOCI categories. And so just reading down from the top, first we have that debit to other comprehensive income. That's where we're eliminating or removing Big's other comprehensive income. Below that we have the $40,900 allocation of the other comprehensive income to the non-controlling interest. And then in the credit column about halfway down, we're eliminating Little's beginning of year accumulated other comprehensive income. So working across OCI, just as we're going to go ahead and eliminate the parent's other comprehensive income, leaving us with the overall other comprehensive income of $204,500. We allocate away the portion of that accrues to the non-controlling interest, leaving us with the $163,600 that accrues to the controlling interest. And we transfer that down to the statement of accumulated other comprehensive income. Now for the statement of accumulated other comprehensive income, just as we do for the statement of retained earnings, we eliminate the subsidiaries, we eliminate Little's beginning of year AOCI, leaving us with the parent's balance of $39,200, add the other comprehensive income to the controlling interest, and we get the AOCI of $124,400.